Hello, I hope you are doing well. My name is Jacqueline Vino from Golosso Learning Solutions, and welcome to this Nano recording. Today, we are going to discuss one of the latest ASUs that has come from the FASB, which is ASU 2025-07. Our focus for today will be primarily on three things. First, some background information and sort of why this ASU was issued, some key changes relating to derivatives and share-based non-cash consideration, and also the effective date and some transition options so you know when and how this may affect your financial statements. With that being said, let's go ahead and get started. So ASU 2025-07 was issued in September of 2025, and its full title is Derivative Scope Refinements and Scope Clarification for Share-Based Non-Cash Consideration from a Customer in a Revenue Contract. A bit of a mouthful for sure, very, very long title. Why did the FASB decide to issue this standard? Well, it primarily addresses two main stakeholder concerns that have really been building over time. First, there were concerns about how to apply derivative accounting to contracts that have features based on the operations or activities of one of the parties to the contract. Think of variables that reference a party's own performance rather than a broad market index, which is more, of a symptom of a derivative. So, what are some examples of this? Any sort of ESG linked bonds would be an example. This is where interest payments or terms change based on the issuer's performance in achieving specific environmental, social, and governance targets. Think about things like reducing greenhouse gas emissions. So we have the ESG items. Another example would be R&D funding agreements. And this is basically payments that are tied to the achievement of product milestones, such as completing clinical trials or getting FDA approval, for instance. And then there's also things such as performance-based contracts. And these are contracts where payment is linked to an entity achieving specific financial results, such as EBITDA or having a certain level of net income or having total expenses of one of the parties. So that's issue number one. Now, issue number two is there was also diversity in practice in how entities accounted for share-based non-cash consideration from a customer, such as warrants or shares, when that consideration is in exchange for goods or services. So what are some examples of this? This could be things like company shares or stock options or, warrants potentially that are transferred to a vendor in exchange for goods or services. These instruments are often also contingent on performance obligations, such as achieving specific sales volumes or certain product milestones. So the issue with this is that some entities were using derivative accounting, some were using the equity security guidance for this, while others were focused on the revenue guidance in Topic 606. And that lack of consistency just made financial statements a lot less comparable. So really the FASB's objective with this update is to make things easier, right? They want to reduce cost and complexity. They want to better portray the economics of these contracts in the financial statements. And this ASU also clarifies how Topic 606 on revenue applies when consideration from a customer is share-based and also non-cash. So let's look a bit more closely at the two issues that this ASU is really trying to address for us. Issue number one is derivative scope refinements. Over time, practice as a whole had developed a broad range and evolving interpretation of what it means to be a derivative, especially when contracts include variables or what they call underlyings that were based on operations or activities and achieving one of the parties of the contract. So stakeholders really pointed that out because these contracts relate to a party's own performance, measuring them at fair value and as a derivative may not provide the most decision useful information if they need to achieve certain net income or certain EBITDA targets. They really didn't think that that was the best indicator. They also noted that other guidance in GAAP exists already to account for these types of contracts. And on top of that, the cost and complexity of applying the derivative guidance, because we all know it is incredibly complex, combined with the belief that the resulting reporting was less decision useful, what that inevitably led to was a lot of entities actually trying to structure their transactions in a way to specifically avoid derivative accounting. They're like, okay, well, if we have to, apply derivative accounting, let's think about other ways that we could actually structure this transaction to potentially avoid that. So to respond to these concerns, the board decided to expand the scope and current exceptions in Topic 815, which we're going to talk about in just a second. So that's issue number one. Issue number 2 is that scope clarification for the share-based non-cash consideration from a customer in a revenue contract. And there was really a big lack of clarity as to which guidance should apply when an entity receives share-based non-cash consideration, which again would be things like warrants or shares from a customer in exchange for them transferring the good or the service. So it's not just typical cash, right? I'll pay, $10 for shoes and, I'll get the shoes and you'll get the cash, right? This is completely different from that. This is, I'll get the shoes, but I'll give you some shares of stock. Very, very, very different in terms of, how we would approach that transaction. So when the share-based consideration was also contingent on satisfying performance obligations, it was really not clear as to how the entity should account for that. Should that be recognized upfront as a derivative under Topic 815? Should it be as an equity security under Topic 321? Or only when performance obligations are satisfied under Topic 606? So this ASU is really designed to clear up a lot of that confusion. Now let's walk through the main changes in the derivatives area of the House. So the amendments exclude from derivative accounting certain non-exchange traded contracts that have underlyings based on operations or activities specific to one of the parties of the contract. So once again, examples of these types of underlyings include things like EBITDA, net income, expenses, or total equity of one of the parties. The reason why the FASB decided to exclude this is that these measures are tied to the performance of a specific entity rather than a broad market variable, right? So that's kind of, a different category there. So if we have an agreement and one of the criteria is that the party in the contract needs to achieve a certain EBITDA, we no longer have to apply derivative accounting, which is hopefully going to make things so much easier. However, though, this exclusion does not apply to absolutely everything. It does not apply to variables that are based on a market rate or a market price or a market index. And it also does not apply to variables based on the price or performance of a financial asset or a financial liability of one of the parties to that contract. So, for the most part, we have this exclusion and we don't have to apply derivative accounting unless it's tied to the market, right? Then it's going to be a little bit different. Now, what if we find ourselves in a really crazy scenario and we have a contract with multiple underlyings instead of just one? So let's say that one underlying is that we have to maintain a certain EBITDA, which means we don't have to apply derivative accounting. But what if there's also another part of the contract that is tied to a market rate or a market price, which does fall under derivative accounting? What do we do if we find ourselves in that scenario? Well, luckily, the standard does give us a little bit of flexibility when it comes to making some of these determinations. Now, what we have to do is evaluate the contract based on whatever its predominant characteristic is. So the ASU revises this assessment to require entities to determine which underlying is expected to have the largest effect on the changes of the fair value of the contract or the embedded feature. So which one is more significant? Is it the EBITDA or would it be, an underlying that is tied to that market price? So we're able to use our judgment here. The underlying will drive whether that contract is subject to Topic 815's derivative requirements or not potentially. All right, so that was the derivative side of the house. Now we also have issue number 2, though, that we still have to talk about. The ASU also clarifies how to account for share-based non-cash consideration from a customer in a revenue contract. Now, remember, people were asking this question. Do I follow Topic 606? Do I follow Topic 815? Do I follow potentially something else? And the FASB decided to answer that question. So what we are going to do if we find ourselves in this scenario is we are going to follow Topic 606, including its guidance on non-cash consideration to contracts where the customer provides share-based non-cash consideration, such as shares or warrants or options in exchange for the transfer of goods or services. So now we know we're going to follow Topic 606 going forward. Now, under Topic 606, the share-based payment is going to be recognized as an asset, and it's going to be measured at its estimated fair value at contract inception when the entity's right to receive or retain that share-based payment from the customer is no longer contingent on satisfying that performance obligation. Now, until that right is no longer contingent, we do not recognize the share-based consideration as an asset, right? So we have to wait until we kind of cross that threshold, so to speak. So they wanted to make this a little bit more clear here. So by clarifying when Topic 606 applies versus when other topics apply, Hopefully, this amendment is going to, once again, just really reduce diversity in practice that was being seen and provide investors with more comparable information, hopefully. So, we're going to reduce some of the complexity and the cost for preparers and reporters, which is something we love to see here at GLS. Now, let's turn our attention to the effective date and transition guidance. So, the amendments are effective for all entities for annual reporting periods beginning after December 15th of 2026 and for interim reporting periods within those annual periods. Also, early adoption is permitted. So entities that want to move to this new guidance sooner can absolutely do so. Now, for transition, entities actually have a choice here. You can choose to apply these amendments prospectively to new contracts entered into on or after the date of adoption. So we can do it prospectively, or we can also do a modified retrospective approach. And what you would have to do if you chose that option is you would need a cumulative effect adjustment to the opening balance of retained earnings at the beginning of the annual reporting period of adoption for contracts that exist as of that date. So again, we have a bit of a choice here that can impact the comparative information and the implementation efforts. So we want to make sure that we're choosing things that align best with our facts and circumstances. And that is all we have for today, folks. So if staying up to date with the FASB is part of your job, consider taking our FASB update course that has all of the recently issued ASUs from the FASB. Additionally, if you're interested in taking CPE from Golosso Learning Solutions, we have also included another QR code for you here. We have lots of different courses in accounting, auditing, government and nonprofit A&A if you need to satisfy your Yellow Book CPE requirements, as well as leadership and professional development courses and audit staff level training. In addition to our live courses, we also have webinars and we also have LC Vista for our on-demand platform. Once again, my name is Jacqueline Vino from Golosso Learning Solutions, and thank you so much for tuning into this Nano recording. I hope you have a wonderful rest of your day.